So simply put, paper trading is very similar to real live trading, with the main exception being you are just trading with fake money as opposed to real money. So for example, with the thinkorswim platform that I use on a day-to-day basis, when you open up the application, there is a very simple toggle button that you can use to then enter the platform with either using your real money in your brokerage account or using fake money. It's very, very simple. And once you enter the platform, pretty much everything else is the same. You still have access to real-time data for both stocks and options, and also futures as well if you make that request to your broker. And you can make very realistic simulated trades that otherwise would be real, but again, the exception is you are just using fake money, and that's really it. So paper trading is a super realistic way of actually trading without risking real money, of course. And so this video is going to focus on the two main situations that I believe you really should consider actually using a paper trading account. And this is actually going to be applicable in my own trading because I've decided for the time being, probably for the next few months, I'm going to be pretty much exclusively paper trading, and I'll explain why in this video too. Now, as always, before we dive in here, my name is Scott and welcome to my channel where I'm here to help you learn how to trade, invest, and master your finances so you can apply that knowledge in the real world and multiply your money. And in case this is the first video of mine you've come across, I also want to let you know that you can find me on Skillshare as well, where you can take my very in-depth classes on options trading and stock market investing. And I provided some links to some of the introductory courses of mine in the description of this video below. So be sure to check them out. And when you sign up for Skillshare using any of those links, you'll get a 2-week free trial. Okay, so the first major situation in which you really should consider paper trading, and this one's probably a bit more obvious, and that is if you are literally just getting started, you're just getting your feet wet in trading, and perhaps you haven't even made your first trade yet. And this is something I wish I did when I first started trading a few years ago, and I can tell you from experience the reason why is because when you are just getting started, you are very likely going to make a lot of mistakes. And I'm talking mistakes like you press the sell button instead of the buy button, stuff like that. And unfortunately, in the world of trading, when you make mistakes, that's typically going to translate into you losing money. And so, of course, that's why I think it's best to make those mistakes when you don't have your real hard-earned money on the line. Make those mistakes early on with fake money so you can get them out of the way first. Get used to your trading platform, figure out what you are doing, and once you have that confidence, once you are comfortable with your trading platform and you've made a few trades already, then you can move over and risk a small amount of your own real money. That being said, I also want to emphasize that you should not be paper trading for too long, even as a beginner, because once you do have your sea legs, so to speak, and you are somewhat comfortable with what you are doing, you should move on and risk a small amount of your real money, because the best way you are really going to learn how to improve and experience the real markets is to risk real money. Right? Because if you are using fake money, especially early on, it's very easy to get lazy, or it's very easy to make bigger trades, take on bigger risks than you know you should, because there's no fear. There's no fear of losing actual money. So of course, if you want to throw $50,000 onto GameStop call options, for example, and you lose it all, no worries. You can just reset your account and start over. But in the real world, with real money, you can't do that. So again, definitely use fake money at the very, very beginning just to get yourself oriented with your platform and to get a few of those easy mistakes out of the way first. But once that is done, then move over to real money because like I said, when you have your real hard-earned cash on the line, you are going to be much more careful and much more mechanical in managing that portfolio. And so now the second major situation in which I would definitely consider paper trading, and this is my current situation right now, and that is if you are very much in a experimental phase with your trading or investing. So in my case, for example, and I'll give you some more context and background into my own experience with trading these past few years, I learned a lot about options and options trading from my time in college, specifically in regards to all the math and the models behind how options work. And in terms of actually learning how to trade them in financial markets, a lot of that knowledge came from places like TastyTrade or Option Alpha. And if you don't know who those guys are, I would definitely recommend checking them out. But essentially, both TastyTrade, Option Alpha, and many others, they recommend the option selling approach that I recommend as well on my own channel. And specifically, when you have bad positions, when you have stocks move against you, the way they recommend you adjust and handle those losing positions is by rolling the contracts. So for example, when you have a short strangle, when you sell a call option and a put option at the same time that are both out of the money, let's say the stock price starts to climb and goes through your call strike. At that point, what you can do is move your put strike up closer to where the stock is actually trading. So you would buy back the original put you sold, and you would sell a new one that's much closer, and you would do this for a net credit. So you would actually take in additional money for doing this, and that's the whole point. The more credit you can take in from selling options, the more you can use that credit to offset potential losses. And then in a very similar fashion, once you get to about 3 weeks away from the expiration date, you would roll the entire position out in time. So you would basically buy back your existing contracts and sell new contracts with either the same strikes or slightly different strikes in the next dated expiration cycle. And again, you would do this for additional credit. And speaking from experience, I can say that this general approach definitely works if you use it correctly. But I always struggle with it, mentally at least, because I knew, and as I experienced last year when the market crashed, that when the market makes huge moves, like we saw last year in 2020, you will likely lose a lot of money. And I remember very clearly when the market did crash last year in February and March. At the time, I was trading with around $10,000. And fortunately, I had mostly defined risk positions on, like put credit spreads and iron condors. But still, when the market did crash by 35% or whatever it was, I lost over 40% of my account like that in just a few weeks. And so as a result, I had to spend the rest of last year just making that money back, which thankfully I did. But still, that kind of situation is not something that I want to deal with in my trading at least. Of course, if you're just investing for the long term, you're just buying and holding, there's going to be crashes, big dips and whatnot along the way. But if you are actively trading, at least in my view, the point of trading is to generate a return that is independent or mostly independent of the market, right? I don't care if the S&P 500 goes up by 20% in 1 year or down by 50% the next year or just sideways, doesn't matter. I'm trying to trade and generate my own return regardless of what the S&P 500 does. And so ultimately, this rolling approach that you'll find with TastyTrade and Option Alpha and a few others, it, like I said, definitely can work over time, but your returns are likely going to be pretty correlated, pretty tied to what the market does. But if you're like Tom Sosnoff, who is with TastyTrade, and you have a massive, massive account, I don't know how big his account is, but it's probably in the tens of millions. Well, in those events, it doesn't matter that much because you can continue to just roll out those losing positions indefinitely if you need to, right? At some point when you have enough capital, you can withstand the biggest moves, biggest outlier moves in the market. But in cases like what I experienced last year with only $10,000, I had to just close out of a lot of my losing positions and just take those losses. And so I'm giving you all this context, all this information because this is the reason why recently, and I'm sure many of you have seen this in my previous videos, but this is the reason why I'm currently investigating and experimenting with a new kind of strategy. And it's still largely based off of what TastyTrade or what Option Alpha do. I'm just trying to add my own personal methodology into it that removes the rare situations where I could lose 40% of my account or 60% of my account in a major market event. So that's why I'm using stock now to hedge my initially undefined risk naked option positions to turn them into defined risk positions essentially. So for example, if you sell a call option, a naked call option, then at that point in time, you have undefined risk. Your losses could be theoretically infinite because there is no cap as to how high a stock price can go. But if the stock starts moving through your strike price and you start buying shares of that stock, at some point, if you own 100 shares, you are now completely covering your obligation on that initially naked call option. So in this way, you are essentially converting a initially naked call option into a covered call option. And at that point, it does not matter how much higher the stock price goes because the losses on your calls will be completely offset by the profits from owning the shares of stock. But at this point, I'm still very much in an experimental phase of trying to figure out at which point should I start using stock as that hedge? Should I wait for the stock to really breach my strikes and then start gradually buying stock? Or perhaps should I buy 100 shares of stock almost immediately once my strikes get breached, etc.? I'm still trying to figure all this stuff out. So ultimately, if you find yourself in a very similar situation like myself, I definitely think it's a great idea to just put your real money account on the sidelines for the time being and just paper trade. Because now I have the freedom to make mistakes, as I definitely have been doing these past few weeks, and to analyze what I'm doing, see where I went wrong, see where I can improve, etc., without losing real money in the meantime. Because like I said, when you make mistakes in financial markets, that's typically going to translate to you losing money. So this is why for the next few months, most likely, I'm just going to be paper trading. And in terms of my content going forward, pretty much nothing is going to change. I'm still going to make live option trading videos when I can, or trade analysis videos, etc. The main difference, of course, is just going to be I'm going to use fake money for the time being. That's it. And then once I've ironed out the details of my new approach, or of course, if it just doesn't work out, I can always go back to the TastyTrade way because that does actually work. And at that point, I'll switch back over and start using real money again. No big deal. But lastly, I do want to emphasize again here that if you do want to do the same thing, if you want to take some time to experiment for whatever reason, just make sure you take it extremely, extremely seriously. Pretend like it's your real money that's on the line every single day, because that is the only way this is actually going to work. If you don't trade in a paper money account as you would in a real money account, there's no point in doing this. You have to pretend your fake money account is your real money account. And so with that being said, that's going to wrap it up for today's video. I hope you enjoyed it. And please let me know your thoughts or if you got questions in the comment section below. And don't forget, if you want to take some very in-depth classes on options trading or stock market investing, then check out my Skillshare courses. Links in the description of this video. And finally, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week, and you don't want to miss out. So thanks again for watching, and I'll see you next time.